Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm happy to be hosting this week's presentation, which is titled Generate Income with Worry-Free Investing. Last week, Ms. Kathy Onan introduced a great trading system where relative safety was the focus of building a portfolio of high RS stocks, simply meaning that they have an established track record of consistent, predictable growth. The next phase of the Worry-Free Investing plan is to have a process that you can follow to generate income by selling covered calls against those stocks that reside in your portfolio. In other words, we're going to go out and charge rent for those stocks for staying in our portfolio. Now, along with just buying a call or a put, the covered call is probably the most popular and simple option trade used for generating income. But don't let the simplicity fool you. It can have a major impact on your portfolio success. Let's start with the basic concept of a covered call and why we should use them. And that reason is pretty clear here in a quote given by a gentleman named Lee Lowell, who wrote a book called Get Rich with Options, which is very popular here at VectorVest. And he says that if you own shares of stock, a minimum of 100 shares or one contract, and you're not selling call options against them, then you are throwing away free money. Well, how's that? Well, there are other traders out there who will give you money today for the right to take your stock away from you if it reaches a much higher price. And that's why we like to use covered calls. And here's the description. The first is the simultaneous purchase of an underlying equity and the sale of a call of the same security. And when you do them simultaneously, it's also known as a buy right. Now, you can also sell one call option against every 100 shares of stock that you already have in your portfolio. We'll start with the P&L profile, the profit and loss profile of the covered call. We can see down on the x-axis at the bottom is the value of the underlying stock. As that value falls, of course, your losses increase. And in this case, we are, as we know, long the stock if we're selling covered calls. So selling that covered call adds absolutely no risk to your position because your risk is already inherent in the fact that you own the stock. And what can happen is the stock theoretically can fall to zero. So that's your max loss. Now on the upside, we are capped because we are selling a covered call which obligates us to provide that stock at a certain price by a certain date, which is the strike price. And so we are capped to the upside. Our objectives when setting out to sell covered calls is number one, to generate cash income. Number two is to reduce the cost of a long position. Remember, we're getting paid, which lowers that cost basis of that underlying stock. And then finally, we're looking to enhance the total return of a long position. The considerations that we need to look at when placing covered call trades is our outlook. First is mildly bullish to neutral. We're going to focus a little more on the neutral here. Our risk is limited to the stock price paid minus the call premium. Our reward is also limited to the call strike minus the stock price paid plus the call premium we receive. And then finally, our break even is the stock price paid minus the premium. And we're going to enter these out of the money. So when you sell a call option while owning the stock, you are writing a covered call, and there are three scenarios. Number one, the stock goes up, in which case you may be forced to sell the stock at the strike price. In other words, you'll be called away. Right? Remember, as an option seller, we have obligations to provide that stock to the option buyer. Second scenario is the stock moves sideways. In that case, we get to keep both the premium for the call we sold, and we get to hold on to the stock as well, as long as it closes below that strike price. And of course, if the stock goes down, your losses on the stock will be offset by the premium sold. Now, if the stock falls significantly, it will not be dollar for dollar, but it will offset or mitigate some of that loss. And as the stock moves sideways or falls, we can continue to repeat the process of selling calls for as long as we hold the stock. So let's set the scene as we go in to show some of our examples. This is a graph of the S&P 500 from January to December, the end of December of 2015. It is not pretty when it looks the way it does here, and it does not look conducive to an easy time making money and generating income in the market. But when we use the worry-free investment techniques, we'll see that it is possible to make money even in this type of market. So we'll go in and we'll do a couple of studies and see how that would work for us. First, I want to set some guidelines for our process of selling covered calls. Number one is that the stocks that we're going to buy are buy rated when we purchase them. Okay, that's going to be part of the parameter. And so the first guideline says that if a stock becomes a hold, then we're going to go out and sell a covered call. Now we can check these stocks daily if we have the ability or time to do that. If not, if we have neither the time nor desire to be that active, we can certainly at the very least check them every Friday to see if that rating has changed. Guideline number 2 is that we're going to attempt to receive at least $1 premium for the calls that we sell. Now it is okay to take less if we have to, based on the availability of strikes and expiration dates that allow us to make that $1. Generally what we'd like to see is somewhere between a 1 or 2% premium based on the price of the stock. So if we can get 1 to 2% of the stock price, that's a good guideline, but sometimes we will take a little less than that if we have to. The next point is that we're going to sell at least 1 strike out of the money and 2 strikes if the premium allows. We don't want that strike to be too tight. We do want to take advantage of any upward movement of the stock as well. And finally, for our expiration date, we're going to go out generally 30 to 45 days to maximize premium. Now, it's also, again, depending on the expiration and premiums available, it's going to be okay to go out as far as 90 days if needed, because what that does is allow us to hold the stock perhaps longer and collect any dividend payouts that are available to us. So those are the guidelines, and let's jump into the program and take a look and see just how we can apply these in our trading. So the first thing I'm going to do is take us into the Unisearch tool, and I'm going to build a scenario here. I'm going to start a portfolio for us, actually a watch list of stocks that would be in our portfolio, and there's going to be one basic parameter, and that is that the recommendation at the time of purchase must equal a buy. We are then going to employ the power of relative safety by simply sorting these stocks by relative safety in descending fashion. So the highest RS stocks are going to come to the top of the list. Now I've set my calendar to January the 2nd of 2015 to start our examples, and so we'll run the search. I'm also bringing back just the top 10 stocks that come into play here. So these are the top 10 stocks on January the 2nd, ranked by relative safety that held a buy rating at the time. For the sake of our illustrations tonight, I'm going to simply tag these top 10 stocks, hit the top one, hold my shift key down, and I am going to add these to a watch list. So when I tag them, I right click, the menu gives me the choice to add to watch list. It has the top 10 stocks here. I just need to go create a new watch list, and we'll call it WorryFree Covered Calls. I'll create that watch list and click OK. I'll then come up to the Viewers tab, and here we have our theoretical portfolio. This is current and live as of today. I'm going to, of course, take that back to the January 2nd date to go back and walk through this process. So I'm now looking at our theoretical portfolio based on the quick search that we just put together. And I've got some familiar names, all with very high relative safety values here, and all with buy ratings as of the time of purchase. And I'm going to start with UNP, because my research shows me that UNP, when we look at a graph, actually went to a hold recommendation shortly after we purchased it back on January the 2nd of 2015. So if here's the year-long graph, and we bought the stock on January the 2nd rather, on that following Monday, UNP actually went to a hold recommendation. And so following our guidelines, we're going to go out and walk through a study that shows how we would set up our covered call. I'll change our date to January the 5th because that's going to be our trade date. I'm going to right click on Union Pacific, and we're going to go analyze a covered call option. So we'll go bullish covered call, and this will bring up our options analyzer tool. Now this is an add-on tool. There is a link in the views that you can click on to get a free 2-week trial, or call our product support floor and we'll set you up with a free 2-week trial for this add-on module. Now the options analyzer is ideally suited to go back in time as a backtesting tool to set up the very best trades over certain market conditions using certain expirations and strike prices so that we can build the very best trade for our goals. I'm going to start by taking the current data tab back to the trade date, as it's always going to be my first step. We then have to edit the information line down below to make sure we have the proper setup that we're going to use to build our option trade. So the trade date is January the 5th. We're going to short a call. With the stock currently trading at 114.60, I'm going to go ahead and start with a 120 call and see if we can set up a trade using the 120. Our expiration date defaults to the very next expiration. Now, UNP does trade weekly options. When I'm setting these up, my first step for me is to go out to the monthly expiration, the next month, which would be February the 20th, would be the next month's expiration date, which leaves us roughly between 40 and 45 days to expiration here. For our purposes, we're only going to use one contract here, and the call I've set up here has a premium for me, a start premium of $1.95. So I like the way that trade sets up, so I'm going to hit OK, and the next thing I need to do is come down to our stock line here. I need to edit that as well. Now, we're going to use 100 shares. Now on January 5th, stock's trading 114.60, but remember our purchase price was from January the 2nd, and that purchase price was at 118.61. So let's keep that up to date as well. So our information is in place. Let's go see what happened at expiration. So on the 20th of February, what happened is that the stock actually rose and would have been called away. So that first scenario of a stock getting called away, well, this is what it looks like. The stock was trading at 123.66 at expiration, and so it will be called because it's above the strike price. We got to keep that initial premium we took in, and we get to keep the difference from 118.61 to 120, again, that price it's called away from us at. So we keep that $1.39 plus the $1.95, and that leaves us with a profit of $334 on the trade. So we waited for the hold, we sold our covered call, kept our premium, made another $1.39 profit on the capital appreciation, and UNP would have been taken out of our portfolio. Again, I'm going to sort these by relative safety, and now I'm going to use DHR for an example, and we'll focus here for a bit. So DHR, let's go ahead and take a look at a graph. Let's go ahead and put our recommendations along the top here. We know our trade date again was January the 2nd. On January 12th, DHR remained a buy-rated stock in the VectorVest program. On the 13th, however, the stock went from a buy to a hold and therefore triggered our covered call sale for DHR. So let's follow the same process we did earlier. Again, our trade date is going to be 1/13. We'll click OK. I'm going to right-click on DHR and let's go analyze our covered call. Again, I'll take my trade date back to 1/13 on my current data. Let's edit our information line. Again, I'm going to short a call. This time with the stock trading at 84.35, I'm going to look at the 90 call is where we'll start, and I'll need an expiration date. Now, DHR does not trade weekly options. It's got January, February, March, and then it skips April and May and then goes all the way out to June. So let's start with the February 90 call, and that's going to give me a premium of only 35 cents. Not quite what I'm looking for. Remember, I'm not adverse to taking less than $1, but 35 cents is a little too low. The March 20th expiration date on the 90 strike does give me 70 cents, and it looks like that's the one I'm going to choose for now, because otherwise I got to go all the way out to June, and that's just too much time for the covered call. I'm going to take this one out to March the 20th. Again, just to illustrate to you that not every strike or expiration works out perfectly, but I'm willing to take the 70 cents here under this condition. We're going to take in the 70 cents. Let's edit our stock position. We have 100 shares, and our initial purchase price here is $85.72 back on January the 2nd. So I'm going to click OK, and let's see what would have happened. Now again, we've held this one out to March the 20th, and on March the 20th the stock closed at 87.15. That's below our 90 strike, so we got to keep all of that $70 premium that we took in. And as it turns out, with the stock rising, we did make $143 at the time of expiration, so we're up a total of $213 at that point. So here we kept our $70 and we still own the stock. Continuing to focus on DHR, it's now 3/20 of 2015, and of course we would be checking our other stocks as well, but for the sake of discussion here, I'm going to stick with DHR, and let's take a look on 3/20. Let's look at a graph, and now on March the 20th, the day of expiration, DHR was still a buy-rated stock. However, it was just the following Monday where the stock had a down day and went to a hold. So that's the next trigger for this particular stock to sell our covered call. So on 323, let's go set up another call option. We'll open Options Analyzer one more time. I'll click Edit. Again, we're shorting the call with the stock trading 84.22. I'm going to keep it on the 90. We're going to do one call option. And let's see what expiration will serve us best. The April 17 only leaves us with a 43-cent premium, so we'll move out to May, which leaves me with an 83-cent premium. Now, earlier I took the 70 cents on DHR, and this is a good example because I just want to show you some of the choices that you would have. So if I want to go all the way out to June, I can choose June and take a $1.43 premium. So I'm getting the higher premium. Yes, I'm going out a bit further, but again, what it does is allow me to hold on to the stock and be able to collect any dividends, which ultimately we will collect from DHR as the process continues. So we'll change that. Once again, we'll edit our stock information, and our purchase price was $85.72. I'm going to go ahead and click OK, and we'll take it out to the expiration. So we would have held it all the way out to June the 19th, when the stock closed again at $85.84. So DHR is trading in a pretty tight channel. So all we're doing is generating income against this stock. We're also collecting dividends. In this case, I took in another $143, and the stock stayed basically flat for that time frame. So I'm getting paid. And this is the perfect example. We're charging rent to the stock to reside in our portfolio as we work through that very choppy, very sideways moving market throughout 2015. Okay, I'm going to close out of that. And from here, I want to jump back into the slides. So we followed our guidelines against some quality stocks that came up using relative safety as the key parameter. And I'm going to focus on DHR results from January the 2nd to 12/18. Why 12/18? Because as we continued to sell our calls, this would have been the expiration date that we ultimately got called away. We would have lost the stock on December the 18th after a year-long holding period where we were able to sell 4 different covered calls against the stock. So on January 13th, as we illustrated, we took in the original 70-cent premium, a little less than we wanted to, but circumstances were such that we accepted that 70 cents. March 23rd, we sold another DHR 90 call. This time we were able to take in $1.43. Following the process, on the 19th, we took in another $1.23 per share, or $123. Finally, on September 18th, we sold another DHR call. This was similar. We went out to December on the September 18th call, which was the 12/18 expiration. And here we were able to take in a $2.10 premium. So overall, we were able to sell 4 covered calls against DHR, which in effect lowered our cost basis from $85.72 all the way down to $80.26. So we were able to take in $546 throughout the process. Now, again, DHR would have been called away on December the 18th because the stock price closed above the 90 strike. So I ran a quick test. January 2nd to December the 18th, the end price, the stock did close at $91.23. Again, we would have been called away at $90, but still a decent return. And again, outpacing the S&P 500 fairly significantly. So let's walk through what we were just able to accomplish. We had 100 shares of DHR at $85.72. It cost us $8,572 to put that trade on. We know that DHR was called away at $90, which left us a $4.28 profit on the stock itself on just capital appreciation, or $428 return, plus the $546 from the call premiums we received from the 4 covered calls we were able to sell against DHR. And hey, let's not forget the $40 dividend payout we received for holding the stock all year. DHR paid a 40-cent annual dividend, so based on our holding period, I went back and checked, and we would have received $10 a quarter or $40 for the year. So with the $546 from the premiums, another $40, that's $586 that we received on the stock, plus the $428 profit we received on our 100 shares equals a total return of $1,014 on the year. So that $1,014 divided by our initial purchase price of $85.70 leaves us with just under a 12% gain on the year. So that roughly 6.5% return from the quick test is nearly doubled to 11.82% gain by adding just modest returns from call premiums received along with the dividends. But I wanted to show a stock that moves sideways through a very choppy market where we were able to get very nice returns, again, from simply selling covered calls and taking in those dividend payments that were afforded to us. So our worry-free investing series began with finding safe, high-quality stocks employing the power of relative safety. Today we talked about generating income, selling covered calls against those stocks in our portfolio. And so I'll ask you to stay tuned, as in the very near future we will be topping off our worry-free investing plan when we talk about using puts as the final piece of our plan to protect ourselves from any dramatic turns to the downside in the market. So the versatility and the flexibility of options can certainly take your portfolio to the next level, we believe. We have upcoming retirement income seminars using the worry-free investing concepts. February 11th and 12th will be in Naples, Florida, Mr. Dan Mish and I. And in March, on the 10th and 11th, we'll be in San Francisco as well. So if you're in the neighborhood, please go to VectorVest.com for details and to register for those live events. And if you are new to options or want to, again, take the next step, we do have a VectorVest Basic Options course available to you. Let us guide you through the laying of the foundation where you can learn to reduce risk, increase profits, and generate income. We have a money-back guarantee on this course. There are 6 recorded sessions that are self-paced. You can watch at your own leisure. And last week, I actually did a webcast where we had, as a bonus to signing up for the VectorVest Basic Option course, a 4 live group coaching session period throughout February, where I will be hosting 1 hour a week every Monday at 4 o'clock, an open forum where we'll talk about tips and techniques. We'll have targeted help for those who have specific questions. And so if you go to the link below at vectorvest.com/4live, you can join in on those 5 live group coaching sessions. I will be sure that you get an invite email to those webcasts. Again, they are recorded in case you can't make the live version. We do record them. Simply go to vectorvest.com/4live, sign up for our basic options course, and we'll add you into those next 4 group coaching sessions through February. I also have a list of option strategies that you could go into the Views tab in VectorVest and go to past strategies of the week and special presentations. They're listed here. And if you have any questions at all, as always, don't hesitate to call our product support floor at 888-658-7638. And again, I thank you for taking the time.